When many people think about investing in gold, many people think they have to buy physical gold. But actually, this is just one of the ways you can invest in gold. And there's actually two more ways. If you want to know what these are, then stick around till the end of this video. Hey, what's up people? Welcome back to our channel, Rao Finance UK. So let us get straight into it. We've seen gold price continue to climb. I mean, it's gained 25% just this year, and it's currently priced at £1,388. And we even saw it push to nearly £1,600 earlier this year, and that was its all-time high. So naturally, many people are wondering whether gold is a good investment right now. Now, currently there are three main factors which have led investors to look at gold and why gold has surged over the course of 2020. And I already made a video on this, so make sure to check that out, but I will quickly say here are the main reasons. So first of all, there are fears of high levels of inflation. I mean, a lot of money printing has happened this year already, especially in the US, and this has caused investors to fear the dollar losing value. And there has been a lot of money printing in the UK as well, but it has been to a lesser extent here. But we always need to consider the dollar losing value because the dollar is the world reserve currency. So whatever happens to the dollar affects our British pound. And so people are now investing in gold as it is a storehold of wealth and a hedge against inflation, which is caused by this colossal printing. I mean, gold can't simply just be printed, can it? The second reason why people are investing in gold is due to the uncertainties we're seeing in the stock market. I mean, the economy is still far away from recovering due to this pandemic, but yet the stock market is absolutely booming. And so people are now uncertain. They're thinking, how long can this last? Again, this is more of a problem in America than it is in the UK. I mean, their stock market has just gone from strength to strength, but we do have uncertainties here as well. And so people are thinking, will the stock market crash again? Well, the thing is, no one knows, but the uncertainties are why many investors are buying gold now. And the last reason why people are investing in gold is low returns on government bonds. I mean, previously, if you wanted a way to protect your wealth, you'd just buy government bonds. They're pretty secure, especially if they're in the UK or the US. Argentinian bonds are a slightly different story. But yeah, these government bonds are pretty secure and they protect your wealth. Nowadays though, with interest rates so low, and in some cases even negative, investors don't want to be investing in these bonds, and so they're buying gold instead. So yeah, these are the three main reasons why investors are buying gold and why gold has surged this year. Now, we have made a full gold video, so do make sure to check that out, but overall, many people think the only way to invest in gold is to buy physical gold, but actually there's three different ways to invest in gold. The first is the most obvious. You simply go out and buy some physical gold. You can buy different size bars and coins, you can take delivery of the physical gold, or you can have it stored in a vault. Now, the second way is to buy a gold ETF on the stock market. A gold ETF will allow you to gain exposure to the price of gold, so if the gold price increases by say £100, your investment will reflect this. And if gold loses value, again, your investment will reflect this. A gold ETF is actually backed up by physical gold in a vault, which is held by a custodian, and it's their responsibility to store that gold. An example of a gold ETF is the iShares Gold Trust IAU, and with this, the gold is held by JP Morgan Chase at their London branch. And the third way to invest in gold is by investing into gold mining companies. The main factor that these gold producers rely on is the price of gold itself. So as the price of gold increases, then they make more profit. So you must have a positive outlook on gold to justify investing in a gold mining company. So first, let's go back and consider physical gold and gold ETFs. Now, there are some major advantages of gold ETFs compared to physical gold. And one of them is that you can quickly trade them. You don't have to worry about storing the gold. Gold ETFs are generally used if you want to invest in gold, as you can quickly buy and sell, and so it is liquid. And another advantage of gold ETFs comes from the price difference between physical gold and gold ETFs. I mean, typically gold ETFs will have a smaller premium than physical gold, as the ETF fund will buy a much larger quantity than what any individual would buy. However, with gold ETFs, you do have annual fees, typically around 2%. And the disadvantage of gold ETFs is that you can never take delivery of the physical gold. And if the gold is lost, stolen or damaged, then there are terms and conditions whereby the custodian, the people who store the gold in the vault, they won't be held responsible. I just want to say, if you are finding value out of this video, then please hit that thumbs up button, as it really helps to get our content in front of more people just like yourself. So you can invest in physical gold and take delivery of this gold, or you can invest in physical gold and have this stored in a vault, or you can invest in gold ETFs. Now, some people invest in the companies that mine the gold, and they may prefer this instead of investing into gold, or they can do this in addition to their investments in gold. When you buy gold and the price goes up and down, then that's what's going to happen to your investment. But with a gold mining company, you're actually betting on how well the company is going to perform and generate profits. But of course, the single largest driver of that company's profits is the price of gold itself. So if gold increases by, let's say, 20%, then the gold mining stock goes up, but it may go up 3 times, 4 times, or 5 times as much. So you might be thinking, how's that possible? Well, the first reason is operating leverage. So let's say the mining cost for a gold mining company is £1,100 per ounce. That's how much it costs them to produce 1 ounce of gold. And let's say the gold price is £1,400, then the company is making £300 of profit for every ounce of gold they've mined. Now, if the gold price increases to £2,000, then the gold mining profit has just gone to £900. So the profits have tripled, yet gold hasn't even doubled, and so we are leveraging on gold. Now, the second reason why gold mining stock may outperform gold itself is due to asset leverage. So again, we'll take an example. Let's say we have a gold mining company who has some unmined gold reserves with a valuation of £1 billion. Now, if the gold price increases, then generally the unmined gold also will increase in value without having to mine that gold. So now the company is worth more, and their stock price will reflect this. Now, you can invest in gold mining companies by either picking the individual companies yourself to invest in, or you can buy a gold mining ETF. Now, a gold mining ETF is where you have a bunch of different gold mining companies all packaged together. And so it's actually a really good way to diversify your risk, as it's spread out amongst all the different gold mining companies. So you're not just exposed to the downside of a single company. I mean, if you invest £100 in a gold mining company, and if that company goes bankrupt, then you're going to lose all of your £100. But if you invest £100 spread throughout 100 different companies, and one of them goes bankrupt, then you're only going to lose a maximum of £1. So investing in a gold mining ETF, it is a more diversified way to invest in gold mining, but it can offer less returns as you're less exposed to the upside of just a single company. Now, we will be taking a look at some different gold mining ETFs in this video, but before I get into it, let me tell you that I am not a financial advisor. I'm just giving you these as examples. I'm not telling you what to invest in, so make sure to always do your own due diligence whenever you make any investments. Okay, so the first example we'll be looking at is the iShares MSCI Global Gold Miners ETF with symbol RING or RING. And this has 36 different holdings, and they've got assets totaling £407 billion. Some of the holdings including Newmont, Barrick Gold and Anglo Gold, and these are regarded as like the 3 of the big 10 gold mining companies. We can see that 19% of the holdings are in Newmont, 18% in Barrick Gold, and 6% in Wheaton Precious Metals. 56% of the holdings are in Canada, 19% in the US, and 13% in South Africa. And over the last 5 years, Ring has averaged a yield of 26.1% per year, and the expense ratio is 0.39%. Now, it's currently priced at around £21. Now, one important thing, if you invested £7,500 10 years ago, you would actually have around £4,700 now. And this is because the industry wasn't doing so well until around 2018, and that's when things really started to pick up. In late 2018, you would have actually been left with a 70% loss. So your £7,500 investment would have only been worth just over £2,000. But since then, gold mining has seen a 240% increase. And so your investment will be worth £4,700 now. And this tells us how risky and volatile gold mining stocks can be. Okay, so the second example we look at is from Vanguard. Now, although they don't offer a pure gold fund, they do offer a precious metals and mining fund, and that gives us exposure to the precious metals market, of which gold is included. And so the example we'll be looking at is Vanguard's Global Capital Cycles Fund with symbol VGPMX. Now this has 47 different holdings and assets totaling £800 million. The 10 largest holdings account for around 40% of the total assets, and in these top 10 we find Barrick Gold with a 4.9% holding and Agnico, which is another gold mining company. They have 3.3% holding. 43% of the total holdings are in North America, 37% in Europe, and 13% in emerging markets. And over the last 5 years, VGPMX has averaged a yield of 5.9% per year. Now the expense ratio is 0.38% and it's currently priced at £7. Again, we do see that similar downwards trend over the last 10 years. I mean, if we invested £7,500 10 years ago, it would currently be worth £3,200. But this did bottom out at £2,400 last year, and since then we have seen a 35% growth. So that is a couple of examples of gold mining ETFs. Again, I'm not telling you what to invest in, I'm just giving you information so that you can do your own research. And now it is worth mentioning that gold mining stocks do have a bit of a history of volatility. So investing in these gold mining stocks, it does come with a higher risk than investing in physical gold. If gold price drops significantly, then gold miners may actually be making a loss for every ounce of gold they mine. And this will eventually lead them to going bankrupt. And if the company collapses, you're going to lose all your money. I mean, gold itself can't go bankrupt, but gold mining companies can. But on the upside, with the value of fuel currently being as cheap as it is globally, this does reduce the cost for all gold mining companies, allowing them to be potentially even more profitable. Now, as an investor who wants to diversify their portfolio, they may spread their gold investments across all three approaches. So they may have some physical gold, a little bit of investments in gold ETFs, and then some investments in gold mining ETFs. And it really does depend on how much risk an investor is willing to take for a certain amount of return. Overall, gold mining ETFs are a great opportunity to be able to diversify across gold mining companies across the world with less than £100. So I hope you found this video useful. Now you know there's 3 different ways of investing into gold rather than just buying physical gold. And so if you did find value out of this video, which I hope you did, then please do give us a thumbs up. And why not subscribe so you don't miss our next financial education video. I'll see you on the next one. Take care.